Hi, this is Stuart Cooper, and today we're going to talk about how do rates affect your buying power. And so what I wanted to do is I wanted to kind of show you a quick example of this based on when rates were lower, when they were around 3% compared to like a current market where we're approaching 6%. So you can see the dramatic effect or cost of housing has become due to the higher interest rates in the last few months. So let's say back in December, you were qualified for a house of $1 million with 20% down, loan amount's 8%. At 3%, your mortgage principal and interest payment is $3,372.83, which is illustrated in the top portion of this chart. And then you can see now, if you were to qualify for that same home and nothing has changed, based on the same kind of ratios, you're now obligation or ability to buy a house is being diminished quite a bit to keep the payment the same. You'd have to reduce the purchase price is $703,000 with 20% down, and your loan amount would be $562,560, and at 6%, your principal and interest payment is $3,372.83. So you can see the effect of that. It really diminishes your purchasing power. Now this shows you exactly based on different time frames in the last 6 months. So I did it at 3% in December, 4.75 in April, and May was 5.5, and then they're using June at about 6%, give or take. So you can see the effects. So if I had a borrower that was qualifying and everything was changed as far as the debt, you can see at 3%, they needed an income of about $150,000, and that's to keep the debt ratio under 41%. Typically, you can stay under 43, even 50, it's depending on programs, but just to keep it simple, I wanted to try to keep it under 41% debt ratio. And when I talk about debt ratio, I'm talking about the back-end debt ratio, which is your principal, interest, tax, insurance, and then any other associated debt you have like credit cards or car payments. That's divided by your income, and that gives me the debt ratio. And ideally, you're trying to keep under 43, depending on a conventional loans. But you can see here that as interest rates went up, how much your income actually had to go up to keep those ratios under 41%. So at 4.75, you need about an income of about $173,000 to qualify. At 5.5, you needed $184,000, and at 6%, you needed $191,000. So you can see how the effect of a higher interest rate absolutely affects your buying power. If you like the content of this quick little video, please subscribe to my channel and like this video. All right, have a great day, guys. Bye.